Welcome everyone. In today's video, I'll be showing you the strategy HCN FX uses in trading forex. Um, on the screen right now, you can see some screenshots of trades I took using this strategy. Alright, so in case you don't know who HCN FX is, her full name is Ndukwe Happiness Shiemela. She is the founder of HCN FX Academy, and she's among the top female traders in Nigeria currently, who are making huge positive impacts in the forex space, both in Nigeria and Africa at large. So she's a day trader, and she always shares her trading insights on her social media handles, her IG, that's Instagram, YouTube, and in her Telegram community. So this her strategy. She has even shared it on YouTube several times. If you go to our YouTube page now, you can find videos of her explaining how to use our strategy. And yeah, so let me show you guys how our strategy works as explained in our video and from my experience using it so far. So while using our strategy, there are 5 confluences she always looks out for before taking any trade. All right, and the first confluence is market structure, which is you need to know the market structure of the currency pair you want to trade. So the first thing you ought to look out for is to read the market structure. And in reading the market structure, you start from the higher time frame all the way down to the entry time frame, which is the 15 minutes. So market structure is basically you reading the structure of the market to tell you whether the current trend is bullish or bearish or ranging markets, because those are the 3 major market structures we have. So to determine whether the market is in a bullish trend, you want to see price creating higher highs and higher low, just like this: higher low, higher high, higher low, and higher high. Okay, so when you see the market structure creating this type of pattern, that tells you the market is in a bullish trend. Tells you the market is bullish. That's a bullish structure. All right, then if you see the market creating lower lows and lower high, lower low, lower high, lower low, lower high, lower low, this is an indication that the market is bearish. Okay, also if you see the market moving like this, I call it a sideways market, also known as consolidating market or ranging market. Just know that the market is undergoing consolidation at the moment. Price is just moving between resistance and support. Between resistance and support. Okay, so this is the first step. You identify the market structure from higher time frame, and you need to do this from the daily time frame. From the daily, you go down to the H4, go down to the H2, that's 2 hours, then 1 hour, 30 minutes, and your entry time frame, which is 15 minutes. So when you see price creating this type of structure, no, market is in a bullish trend. When it's creating this type of structure, it's bearish. That means you are looking for sales only. And when it's ranging, you just avoid the market totally, because this strategy only works perfectly for trending markets. That's for bullish or bearish markets. All right. So the next confluence to look out for is break of structure. So the break of structure, you need to, now after identifying the market structure, and let's assume you notice the market is bullish. Okay, let me delete this other drawings first. So after carrying out your analysis on the market structure from higher time frame to the lower time frame, you notice market is bullish from the higher time frame. Now you go down to your entry time frame to look for the current break of structure in direction with the higher time frame market structure. Do you understand? That means you go to, okay, first of all, let me explain what a break of structure is. Now, like I said, price is bullish. Okay, price is pushing up, all of a sudden it's coming down. As it's coming down now, this place that price rejected from now, yeah, it's a resistance. Okay, that's a resistance point. Now once market pushes back up, and breaks this level, it becomes a break of structure. That means market is about to continue the bullish trend, so there will be a pullback to any significant point of interest around here and continues the bullish move. Exactly. This is known as the break of structure. Okay, so your higher time frame is bullish. On the lower time frame now, what you need to look for is the current break of structure in direction with the market's structure. So that's the break of structure. So after spotting the break of structure, the next confluence you should look out for is the origin. Now the origin is where the impulse move started from. The impulse move, which is this move from year to year, this move from year to year is the impulse move. The impulse move is a move that causes the break of structure. Now you look out for the origin order block. The origin is usually around here. Now all you need to do is mark it out with this tool and extend it forward. Now that's your point of interest. That's where you're looking out to take your trade from. Okay, so after spotting the origin, like I said, is where the impulse move starts from. It can be a bearish candle, it can be a bullish candle, but the last candle after the slight consolidation here, or the slight pause of price here before the sudden push up, yeah, that's your origin. The last candle there before the sudden impulsive move upward is known as the origin. So you mark it out. That's where you are anticipating price to pull back to before continuing this bullish movement. Okay, now to the other two confluences are to validate this origin zone. Okay, and they are, okay, let me write it out here first. Third confluence is origin. Spot your origin. Okay, so the fourth one now is okay, let me explain first. Now, to consider this origin as a valid one or something that has high probability, there are other two confluences you need to look out for. Okay, and that's liquidity and imbalance. You know, I said this origin is where you want price to come to and react from. So this is why expecting something like this price to just pull back down, tap into our origin, then boom, continue with the bullish move. All right, but there are other things we want to see before this movement occurs, and that is liquidity, number one. So I want to see, so it's best to see market creates a liquidity zone that they're going to sweep before continuing this bullish move. So you are expecting to see something like this, market pushes down, but it won't get to our origin immediately, to pause somewhere around here, very close to the origin, very close to our origin, then pushes up a little bit, might come back again, push up. All this is just to confuse traders. Some people will just be jumping into this trade now, not knowing the market makers know what they are doing. They're just creating a liquidity pool where they're going to raid before continuing the bullish move. So after price has done something like this, you can see they have created a liquidity zone for us, which is right here. This double bottom becomes our liquidity, LIQ. Okay, so our next thing we expect market to do is push down, that's clear out all the liquidity here, tap into our origin, and boom, continue the bullish move. Do you see that? Hmm? Okay, then the other confluence you need to see to make that origin a valid one is called imbalance. It's called imbalance. All right, so an imbalance is let me go to the chart to explain this for you. Okay, let me use here as an example. You can see this breakup structure right here, breakup structure to the upside. Okay, here is the origin. That's the last candle before the impulsive move upwards. Like imbalance, they occur when there's a sudden impulsive move in the markets causing breakout structure. So the imbalance, you can see them when there's a gap between two candlesticks. Let me zoom it out for you. Okay, do you see this gap between this candle, this bearish candle here now, the highest points, which is this tip here? You can see there's a gap between it and the third candle's low. Normally the candlestick is supposed to pull back down to at least get to this high of this bearish candle to fill in this gap. So there's a gap around here. That's what we know, that's what we call an imbalance in the market. Price usually comes back to fill such imbalance. Okay, so if you have this kind of imbalance before your origin, then that makes that origin a valid one. The probability of it holding is very, very high. Okay, so back to my illustration. So let's assume there was an imbalance here as well. Imbalance, also known as FVG, fair value gap. Okay, so this is the ideal setup using a strategy. Okay, all you need to do after mapping out your market structure, using this example now, your market structure you turned out to be bullish, you go down to your entry time frame, you map out the most recent break of structure in direction with your market structure from higher time frame. Then you map out the origin that caused that break of structure in your entry time frame. Then you look out for liquidity and imbalance, fair value gaps, to make that origin point a valid one. Then all you need to do is set your pending order here. Set your pending order there. Set your take profit at the high where price is pulling down from, and you set your stop loss at the low of the origin. You see that? Set it at the low of the origin, just some pips below the low of the origin. And your take profit will be at the previous swing high, which is where price is pulling down from. Okay, that's just it. That's just it. So if you want to take screenshots of the confluences, you can just screenshot it right now. Then this is the trading model. This is how your setups using the strategy are supposed to look like. Okay, so let's go to the chart now. Let me show you some examples. All right, so let me show you some setups on the chart. So the first thing to do is read the market structure, and to do that you have to start from the higher time frame, which is the daily time frame. So currently this pair we're looking at right now is GBP JPY. So analyzing this market structure, you can see that price broke market structure here to the upside, signifying a bullish trend. So and the source and the origin for this break of structure is right here. You can see that price has already tapped into it and is currently reacting from it, continuing the bullish move upward. Okay, so the most recent break of structure is here as well, to the upside. Here was also a break of structure. Here was also a break of structure. It does not look clear now in the daily time frame. Was we drop to a lower time frame now, everything will be very, very clear. Okay, break of structure, break of structure. Okay. And this is the H4 time frame. When price got to that origin from daily time frame, you can see what happened here. After this last break of structure to the downside, while price reversing up, creating a change of character here. These terminologies, they are from the SMC concept, because our strategy, she derived it from the SMC concept, that's smart money concept. So that's where all these terminologies are coming from, the change of character, break of structure, and all. Okay, so this is the H4 time frame. You can see market is bullish. All right, so if you notice here, before this break of structure that happened here, the origin that caused it is right here. It's from the H4 time frame. Okay, so we're going down to the lower time frame to trim the origin smaller, because right now it's too big. If we are to take this trade now, the stop loss is going to be too wide. All right, this is the 2 hours time frame. Okay, the origin is also within that H4 origin range. So let's still go down to lower time frame, the H1. Okay, we can take here as the origin from the H1 time frame. I think we can still trim this. Go to the 30 minutes time frame. From the 30 minutes time frame, it's even more clearer here. This was the last candle before the impulsive move started. You see it? Before the impulsive move started. And this was our liquidity. Our price had to sweep before continuing the trend. That's our liquidity. You can see fair value gaps present also here. There's fair value gap there. Okay, so which other thing do we need to see? Yeah, that's all. So what we would have done was just take out our long position to place it here. Set your stop loss below the low of the origin. Then aim for whatever you want. You can aim for this recent highs here. If you want to collect more from the markets, you can aim for the highest point, which was somewhere here. And price actually got there. This was a 1-to-7 risk to reward ratio trade. A very smooth and sweet one. You see that? And price continued breaking to the upside, continuing the bullish trend. Can you see that? Break of structure again to the upside. So now you look for the origin that caused this break of structure. I would have preferred to use somewhere here. And if you notice, price didn't pull back to this zone. Instead, it pulled back to this fair value gap that's present here. That was what price reacted from. Can you see it? That was where price reacted from, this fair value gap. So we wouldn't have been able to take this trade and see price still continue with the bullish move, break market structure here again, pull back to another source, other block which is inside here, and it's going up again. So that's just how to use this strategy. For a bearish setup, it's just the reverse of everything I just explained now.